This is the Money Seed Podcast, where we discuss all things investing, plain and simple, the way it should be. Please remember, this show is for educational and entertainment purposes only and is not intended to be investment advice. Welcome back to the Money Seed Podcast. Today, I am very happy to have Chris Odegard with us. Chris is a blogger. He's an investor. He's the author of Get Off Your Ass and Manage Your Money. And Chris is here to challenge the conventional wisdom. Chris, welcome to the show.
Hey, Gabe. Thanks for having me on. Really looking forward to our talk here.
Absolutely. Chris, let me play devil's advocate right off the get-go.
Yeah.
We are being told every day, right? Just save money, invest in your 401k, buy mutual funds through a trusted financial advisor, and you'll be set. What is wrong with that wisdom?
So that conventional wisdom is to accumulate this mountain of money, mutual funds basically through your employer's 401k while you're working. And then you have this mountain of, you have a balance sheet. And you can't live off a balance sheet, right? Because unless everything was a dividend, producing stock, all you have is these assets that don't produce any cash. And then when you decide to quit working, you sell them off bits at a time and to generate the income to fund your lifestyle. And hopefully you don't run out of that money while you're still alive in retirement. And I would, that conventional wisdom, it does work. It works for 8% of the population. It doesn't work for the other 92%. And I'll tell you how I got there. So financial planners use something called the 4% rule. And the 4% rule says, if you've got this mountain of money, you can probably safely withdraw 4% a year to generate your retirement income. So a lot of people, the conventional question is, well, how big does that mountain of money need to be? Well, I think that's the wrong question. The right question was, well, how much income do you want to have in retirement? So if you figure out how much income you want and then use the 4% rule, that will tell you how big the mountain it has to be, right? So let's just pick a number. Let's say you want to have $100,000 a year income in retirement. If you apply the 4% rule, which is divide by 4%, that says that you need to have a portfolio of $2.5 million in order to sell off 4% and hopefully and generate that $100,000 a year and not run out of money while you're still alive. Well, let's say, and I would say there are a whole lot of people in the United States that are not going to have a $2.5 million 401k portfolio. And so let's say maybe that's a little bit greedy, right? Let's go with the median U.S. income, which is somewhere around $63,000 last time I checked, and you apply the 4% rule, you still need to have $1.5 million. Well, how many Americans actually achieve millionaire status?
I can tell you it's
8%.
That's exactly what I was going to say. I was going to say roughly 1 in 10 households in America have at least $1 million in net assets, which is shockingly low. Yeah.
Right. Well, but so the conventional wisdom works for that 8% of the population that are going to have $1 million or more in their 401k portfolio. For the rest of the people, they're going to have a really degraded standard of living in retirement because they're not going to have those numbers. And it even gets better. So the 4% rule came about decades ago, and because of current market conditions recently, the 4% rule isn't really holding water anymore. So now they're talking about a 3% rule. So if you apply the 3% rule to the $63,000 a year median income, you're back up to over a $2 million portfolio. Yeah. So I think it's interesting that this system that is being pushed at us, family, friends, coworkers, the employers and, all the companies that make money with, the big brokerage houses, it doesn't work for 92% of us. So, I went to public school and, even that was a failing grade if only worked for 8% of the people, right? So, and then I'll just, if I could just continue on just a little bit, the two big selling points for the 401k are the company match and the tax benefits. And the company match is no more than somebody else. It's somebody else's money, or what we like to call OPM, others people's money. And then there's a tax benefit. Well, instead of, putting, let's just say you were putting $30,000 or $20,000 a year into your 401k, and then you would get, $30,000 a year of mutual funds. What if you didn't do that and you forwent the tax benefits and the company match, and you said, you know what, I'm going to take that $20,000 or $30,000 and I'm going to use that money as a down payment on a single family rental? Well, you would get $100,000 house if, depending on the loan to value, and the single family rental comes with the same thing. So there are other people that will give you money, and it's called the tenant, and they're paying off your mortgage over the next 30 years. They're not giving you a one-time match. They're giving you a match every month for the next 30 years, and that's called paying off your mortgage. And the government gives you a tax benefit, not just when you make the one-time investment, but every year over the next 26 and a half years in the form of depreciation. And I wrote an article on my website, and I compared these two with real numbers, and the tax benefits and the other people's money benefit of investment in a single family rental compared to putting that money in a 401k. It's almost 3 times as valuable in terms of the dollar amounts. So the 401k doesn't even work on its selling point compared to a piece of real estate. So that's a very long answer to your question.
And I think you went off in several different directions there, but definitely. Now, I want to get back to that comment that you said earlier about comparing the 401k and the real estate, et cetera. But before we go there, I just want to say something scary, because I find that scaring people is a great way to motivate them. And I love the title of your book, and we'll talk about your book in a few minutes, but the title, Get Off Your Ass and Manage Your Money. It sounds like you really want to kind of get this message out there. You want people to take it seriously. And maybe instead of outlining it the way you did, which was saying, look, you need this many millions in your account, the other way to look at it is, just before I came on this recording here, I looked it up, and the median, not the average, the median 401k balance for Americans between the ages of 55 and 65 is $85,000.
Right. That's a far cry from the million or the 2 million that we talked about, right?
Oh, it's a very far cry. And if you think about that, let's apply the 4% rule, which would be roughly like $3,200 a year, roughly. And now add Social Security on top of that. Okay, maybe you're at like, 10, 15, 20,000. Let's say $20,000 a year total with Social Security, plus that $3,200 a year. People need to ask themselves, can you live on $20,000 a year?
Yeah. How is that going to work?
I mean, even if you have your home completely paid off, you still have to pay property tax. You still have to pay your heating and your water. You still got to put food on the table.
And you still got to have fun, hopefully.
and I mean, that's a serious question. Can you do that on 20,000? And I'm gonna just say, like, flat out, most people can't. This is why poverty in retirement is a huge problem in America, and it's just gonna get worse.
Right. Yeah.
Absolutely. And I don't want to scare my listeners even more, but Social Security is starting to turn negative as well, which means the disbursements from Social Security are now more than the money coming in. So, I mean, that Ponzi scheme is going to go through some kind of a reform in the next 10, 20 years. So, I mean, I love the message is that I'm disappointed and maybe even angered that Americans are being fed this story that you don't even have to think about it. You don't even have to worry about it. We'll just take that 1% or 2%, management fee from your account. You got nothing to worry about. You'll be fine. Right. And like you said, 90% of Americans will not be fine. Yeah,
they won't. No, it's and whether, I mean, if scaring people is, what I want to do is give them the facts, give them some real numbers. I'm not making this stuff up. The percentage of millionaires, we're using the financials industry's own, terms and formulas to prove that this just doesn't work. I'm not making this stuff up, right?
Absolutely. So, Chris, I believe that you yourself went through a bit of a hardship in your 40s. You, I think from the description, I read that you lost a little bit over half your net worth, and yet you were able to kind of build it back up again. Yeah. I would love to hear that journey. It sounds like it's an inspiring story. Tell me more about how that all went down.
Yeah, so to begin with, I want to say that for decades, I was just like most of your listeners, viewers, most Americans. I was a conventional investor for decades, and then, like you said, in my mid 40s, I went through I use this fancy technical term to say what I went through. I went through an illiquidity event, which is where you have lots of money leave your account. In my case, it was caused by a divorce, but it was 55% of all the assets that we had and thousands of dollars a month in cash flow, for a limited period of time. And that has been, more than a decade ago. But, I've known lots of people, mostly men, who have gone through divorce, and the attitude of most people is, well, I'm just going to have to work longer. I'm going to have to get a second job, or I'm never going to be able to retire. Most people don't look at that and go, how am I going to pull myself out of this and get back to right where I was, and even blow past where I was before this happened. And I can't say that I just, came out of that with that attitude, but a couple of things happened. A friend of mine said, "Hey, Chris, there's this book that you should read." And he told me the title of the book, and I bought it. And like most books, it sat somewhere for a while before I actually did. But I finally picked it up, and I was on a business trip, and I read the book on the airplane, and it was Robert Kiyosaki's Rich Dad, Poor Dad. And that just kind of exploded my brain, because he's just talking about money in a whole different way. And I would say this is key to your audience, is that to be open-minded. There are plenty of people who will read that book and go, "Oh, I've never heard that before. Must be a Ponzi scheme. It's got to be too good to be true." Well, have a childlike curiosity. When kids are growing up in the world, they believe everything that you tell them, right? So, don't run away from stuff. Anyway, I read that book, and I was highly motivated to move in that direction, stop being a conventional investor. And I was sitting in my post-divorce, what I call the down by the river apartment, if you've ever seen the Chris Farley's skit on Saturday Night Live. So I was there, and an advertisement came on the radio, and Robert Kiyosaki's Rich Dad training organization was having a free seminar. And so I was like, well, this is like almost divine intervention. Here I am. I read the book. There's a class here. It was about 40 miles away. And on the day that I was going to go to that class, my 92 F-150 wouldn't start.
Oh, no.
And I was like, I have got to go to this. And I found a rental company that would drop off a car, and I got to the seminar. And if you've ever done any of this type of continuing education, the free seminar is just the first step to the paid seminar. And then anyway, at a time when I couldn't afford it, I put $10,000 or $15,000 on a credit card in the form of a training package. And my high school son and I traveled around the country for, 2 years, taking classes on every different aspect of real estate investing. And he is a commercial real estate broker today, and I am primarily a real estate investor. But let me shorten the story here. So I moved in that direction: single-family rentals, small multifamilies, and all kinds of different alternatives. And we'll define that in a minute. And lo and behold, 9 years went by, and I had recouped that 55% and multiplied it many times over. I quit my corporate job, and earlier than what I was planning on before this all happened. I went, wow, if I could do this in 9 years, maybe I should write a blog, which is when I started writing my blog and trying to share this information. And the book came last year. So that's the story. So it's amazing what you could do in 9 or 10 years if you really, use all the tools, pull all the levers, and really go full out in a different direction.
That's amazing. I love the story. And it's funny because most guests I have on the show, I ask them, what are your favorite investment books and what books do you like? And Rich Dad, Poor Dad is almost always at the top of that list. Yeah. I mean, it is probably one of the best selling personal financial advice books out there. And it's because it's that good.
Yeah,
and
it really is.
It really does open up a whole new way of looking at the world. A lot of people, if you're reading it for the first time, you come across, you're like, wow, I had never looked at money and investing the same way. Yeah. I would love to know a little bit more about your real estate investment strategy? Do you go after BRRRRs? Do you go after single rentals, multifamily, syndication? How do you approach it?
Well, today, I've gone through. I'd had single family, small multifamilies, and I dabbled in performing and non-performing notes, and I've really just settled down into being a passive investor in syndications, and primarily multifamily, but a little bit of self-storage and things like ATM machines. And I wrote an article where I talked about there's three ways to invest in real estate. There's the, do it yourself, single family rental. And then there's the, where you would actually go. I don't know if you're familiar with a turnkey single family rental provider. That's where somebody has already went and bought the house, they put it under property management, and you're basically just buying a loaded rental. That's another way. And then the third way is there's lots of ways, but the way that I do it is just sending off a check to somebody who is an expert in multifamily, self-storage, you name it, and letting them run the deal. And as you go across this spectrum, your time in the investment is most with the do-it-yourself, and it's least with the syndication. But here's the interesting part: the amount of money you make is higher over here in the syndication, doing the least amount of work, at least in my experience. And I wrote an article, and I did some numbers. I took some rental houses, and that were provided by turnkey rentals, and then I have my own experience on syndication. So.
And Chris, were you able to go straight to syndication, or did you actually try other real estate? No, I did. Methods?
No, I did other. I think I did other stuff first. I owned some stuff outright in the beginning, and what I was finding was, I was looking at financial reports and going, wow, is that all the money that I made over the last 12 months, and not even considering the amount of time that I put into these deals. And I think it was about the same time around 2008 when the laws changed around syndications, and that became an investment that was more available to mainstream investors, primarily if you were a accredited investor. So it was something that wasn't in my vocabulary. And the first thing I ever did was a note fund. I was doing performing and non-performing notes, and notes, in my experience, have been really difficult, especially the non-performing stuff. And so the guy put together a note fund, and he was kind of showing the details about here's kind of what the average do-it-yourself note investor is making, and here I'm going to give you this. And there wasn't a big difference between, the curve in terms of the ROI. I was like, I would rather just not have this headache. And so anyway, once I kind of got a taste of that model, then everything kind of started moving over in that direction.
Chris, tell me a little bit more about notes. What exactly is that when you mention notes fund?
So I think a note is just a loan. So a promissory note. So the note is the kind of the industry term. And so, if you own a house, you have a mortgage. Typically, that's a note. And sometimes the bank owns that mortgage, or sometimes an investor like me might be the owner of that note. So I'm, the loan is a liability to you, and it's an asset to the bank or me. And so what happens is, especially after we had the 2008 crisis, banks are in the business of loaning money, and they have these, and the houses or the properties are just the security for those notes or for those loans. So when all of a sudden there were all these foreclosures, the banks they're not experts at managing all these properties. And so they did that for a while, but then they said, you know what, I would be better off just selling these notes. So if the bank has a note that has an unpaid balance of $100,000 and it's non-performing, meaning the borrowers aren't paying anymore, they might sell me that note for $30,000. Or $20,000, and so I could buy that from them, and then I've got all this room to work, with the borrower now. I mean, I've only got 20 or 30,000 into this, so I can restructure it, the length of the term, the interest rate, tack some stuff on the back. And my objective was always to get these people, keep them in their house, but get them on a schedule or that they could pay, and I could make a good return, and it was a win-win situation for everybody. But that was a lot of hard work, and it was just my kind of philosophy is I like to make the most amount of money with the least amount of my time involved.
Oh, absolutely, absolutely. And it sounds like it might be particularly difficult because the individuals in those homes are probably distressed already, right? They're also going through a difficult time. They have financial challenges. It's interesting how you mentioned the 30%, $100,000 loan for $30,000, because that 30% is roughly how collection agencies work, right? A collection agency will buy a non-performing credit card debt or et cetera, and usually they'll pay 30 cents on the dollar for the right to collect that loan.
Right. Yeah. It's a supply. The pricing on notes is a supply and demand thing. How many notes are out there? And to be fair, I mean, this is where alternatives are kind of, it just depends on the investor. I mean, there are plenty of people that love notes, invest in notes, and make a lot of money in notes, but I wasn't any good at it, so.
Yeah. And it's interesting how different people have different skill sets. For example, I'm also a real estate investor, but so far I've stuck to single family homes using the Burr strategy that was made popular by the Bigger Pockets podcast, which I'm a big fan of.
Yep.
One of the reasons I would love to get into syndication, one of the reasons why I haven't done it so far is I'm just not a good salesman. I'm not confident myself. I don't have the self-confidence to say I can sell something to another human being. And so that's one hurdle I'm working on right now is, how
you mean get into it on the syndication side as a general
partner? Like I would love to,
right.
Be able to talk to 10 investors and pool money and buy an apartment or like a multifamily or something, like an 8-unit or a 16-unit or something. What I'm working on now is to develop that self-confidence where I can talk to a group of people and convince them that I have the expertise. You can invest with me. I know what I'm doing, blah, blah. And so how did you get over that hurdle?
Well, I don't do any syndications in terms of that. I mean, I'm simply on the limited partner side. So I don't do that. And I thought that was going to be my next path. Excuse me. I went to a syndication class that's put on twice a year by a particular group. And I went and I was like, wow, this looks like a lot of work. This is a job. And, I've gotten to the point where I don't trade my time for money anymore. So if there's anything that even looks or smells like a job, I just don't go down that path. And so, anyway, yeah, I mean, I kind of, look at my skill set as just, I'm finding people that are just the best at this particular thing, and I invest alongside them. And with doing that, I regularly get almost always get more than a 25% average annual return, and sometimes that's tax advantage, And if I can do that by just wiring off my money, I don't want to spend 20 hours a week to get an extra 10%. I just don't. I'd rather be doing other things.
I mean, 25% is phenomenal, and congratulations on that. That's amazing.
Well, and think about this. Back to why the conventional wisdom doesn't work. I think the S&P 500 index's return over its history is sitting just shy of 10%. Right now, if you look in today's environment where real inflation is over 10%, and then so you get your 10% return, you've got inflation, and you've got taxes. You're not really even maintaining your buying power. So you're not even getting ahead with those low returns.
I agree. So Chris, at what point did you wake up and realize, wait a minute, I have enough cash flow and I know what I'm doing, that you were confident to say, I'm going to quit my job. I'm going to quit my job. I don't need this job anymore. I'm good. At what point did you realize that you are home free?
Well, I don't think it wasn't that clear. I had been, so I had been doing this for about 9 years. So 40, 45, 55. So around 54, 55 is when I was like, I think I might be able to do this, but I didn't, it wasn't, I've heard people, mostly sports coaches, hey, if you're going to win decisively. So it wasn't that decisively that it was just a no-brainer. I did find a non-traditional financial planner to work with, just to look at everything and put all these numbers together with the different rates of inflation for, the general stuff in the economy, and then a different one for healthcare. And he was able to help me decide that I could do it. So it wasn't a slam dunk.
And Chris, right now, if I may ask, your day-to-day expenses is it all funded from cash flow, or are you are you using the 4% rule and dipping into your long-term investments?
It's all cash flow.
It's all cash flow.
So let me and one of the things the financial advisor said, let's just say I don't know, 10, let's say he approached it like this. Let's say your expense, you need to know what your expenses are. That's where you start. Let's say it's $10,000 a month. He said, Chris, we need to try and build you a base of stable, guaranteed income. And so we did that basically with some annuities. So I took some retirement money, and instead of, putting it in the stock market or whatever, we laddered up 4 different annuities to almost cover, let's say $10,000 a month. So I get 4 paychecks a month, and that pretty much covers all my basic living expenses, and all the other real estate stuff and everything else I do, that's just icing on the cake. And then I decide how much, and I just look at things in terms of if there was $1,000 bill, I just look at things in terms of $1,000 bill. Do I want to give myself $1,000 a month raise because I want to enjoy, do some things in 2023 different than, and I go, okay, where can I pull 1,000 here, 1,000 here, 1,000 there? And I just bump up I give myself a raise. But the first 10,000, for example, is just coming all day long. Which is really nice because, I've had some investments go bad and not do as well, and I don't have to sit here. I don't know how stock market investors and guys that are retired do this, and they're going, okay, which stocks am I going to sell this month? Because of the volatility in the stock market. I don't think I can sleep like that.
Interesting. Yeah, good perspective. So, Chris, at what point did you decide to write the book, Get Off Your Ass and Manage Your Money? What was the impetus behind it, and what can we learn from reading the book?
Well, so I started this blog right before I quit my corporate job, because I thought in the past 9 years it was kind of funny. I thought, wow, this has really worked out. I'm going to quit my job, and I knew what I had. Now I was kind of a sophisticated investor. I had a bookkeeper. She generates financial reports. I know what my net worth is, and I was like, wow, I know where I am now. It's too bad I didn't have this level of sophistication 9 years earlier to be able to say, hey, I went from here to here, because I was kind of trying to justify the fact that I had the knowledge to actually do the blog and write this stuff. And then a light bulb went off, and I went, wait a minute, guess what happens when you get divorced? The lawyers make you do what? Create a balance sheet so you can split that up. So I went back and I found the balance sheet, and I went, oh my gosh, from 2008, 2009, when I had this liquidity event, 9 years later, I had taken that loss of 55% and multiplied it 5.6 times. And I went, okay, I think I have some credibility. That's
incredible. Wow.
Yeah. But anyway, so I was right. I didn't know anything about WordPress. I'm not that kind of. I'm very literate technology wise, but not that way, right? I like to use it, and so I started this blog, and I hired a gal, and every week I said, I want to learn how to build a website and use WordPress. And I said, I want to learn it by you teaching me every Thursday night from 7 to 8 o'clock. And so over the course of a few months, we built my first website, and it has, evolved over the years, of course. And then I hired a business coach. I said, well, how do I expand the reach of this? I'd been writing articles for about 4 years at that time. And one of the questions she said was, well, can you write a book? And I said, yes, I can. And I've always liked to write. And so I said, yes, I can write the book. And, one of the funny things, about the title is, and I did have a separate a book coach as well. And they said, well, the title should be simple and clear. You should be able to read the title. It should be clear, and you should know exactly what the book's about. So that's kind of how the title came about. But more specifically, so what you're going to learn in the book is, what the conventional wisdom is, which we've talked about, and we're going to learn what alternatives are and conventional investments are. And conventional investments are everything that's publicly traded, all stocks, bonds, mutual funds, and everything else, commodities, private equity, real estate, crypto, all that stuff is alternatives. And I have in the book, I have something called a hierarchy of investors, which is kind of came to me thinking back of Maslow's hierarchy of needs. And in the shadow of this hierarchy are the conventional investments. They're in the dark, in the shadow, or there's nothing good's going on there. And as you get up on the pyramid, you get all these benefits. You get higher returns, you get better tax treatment, you get less volatility. And so there's 13 different categories that I compare these, and alternatives are better in 11 of the 13. So why would you stick with conventional investments when they're just inferior? And then I take one of my investments, which is an ATM machine syndication. And the reason I picked that and use the example of the numbers is because the number is fixed. I put a certain amount of money out, and every month I get a check that's fixed. And so I use that example to run through those 13 different categories with this investment specifically, and then talk about it generically as well. And so the objective is at the end of the book, I will have convinced you that you need to go in a different direction. And I have kind of an action guide and a checklist to kind of help you make that transition, because you have to be, with the conventional wisdom, if you get a job, they automatically enroll you into the 401k. They automatically decide how much you're going to contribute. It automatically goes into a certain mix. Alternatives aren't like that. You're going to have to be smarter and figure out of this vast world of investments what works for you. Like notes didn't work for me, but the limited partner stuff in multifamily real estate does. So that's something that nobody can answer for you. You're going to have to start listening to different podcasts, reading different books, attending some meetings, find a real estate investment group to join and start immersing yourself in this world. And it's going to be a little bit of work, but it's going to be very worthwhile for your financial future.
I love it. Chris, if somebody reads your book, you mentioned that in the book you have a checklist and sort of like a guide on next steps.
Yep.
How hands-on is it? And can somebody take that book and go to a financial advisor or a financial planner and say, this is what I want to do. Can you guide me through it? I mean, how easy it is to take the steps, or is it?
It's really, first of all, you cannot take it to a financial planner, because financial planners don't work in the alternative. I would say 95+% don't work in that space. And I have a friend who's a financial planner, and I asked him why, and he said 2 reasons. The mutual funds, it's easy, repeatable income for them. Mm-hmm. That was the one reason. And the second reason was if a financial planner recommends a stock or mutual fund to you, and that investment goes bad, they won't be sued. If they recommend an apartment syndication to you and it turns out to be a Ponzi scheme, they'll be sued. So it's just easy, repeatable money for them. So that's why most of them don't do it. And like I said, I got some stuff in the book, and there's a downloadable checklist. And it's really an education process that I recommend that you go through. And at the end of the day, what I'm trying to get you to is you've looked at and learned something about all the various alternatives that are available. And you said, and you come to the point, you know what? I think that I would like to be a syndicator. And then you got to go off down that path. But I'm trying to wade them through all the different options, and then they, based on what their risk tolerance is and how much they want to time they want to invest, there's some investments that'll be better for them than others. And that's just something that's an individual thing that everybody has to figure out by themselves, with a little bit of guidance from me.
Yeah, my own personal experience with financial advisors tells me that you just have to know who you're speaking with, and if you have a choice, always try to pay for their time, because if you're not paying for a financial advisor's time, it means you are paying them through commissions that you probably aren't even aware of. Right, and unfortunately, with commissions, it does give some financial advisors, sadly, different priorities, right? So they might sell you something that maximizes their commission, or as you mentioned, maximizes their recurring income, rather than tailoring something that works for you.
Yeah.
And so that's always an asterisk.
Yeah, it is. And let me give you an example of the apartment syndicator that I use. So in these syndications, you have the general partner. So that is the one or two or three people that are in charge and are running this deal in this company. And then you might have 100 or 200 of us that brought together the $20 million to buy this 400 unit apartment building. And so what I like is that with this particular syndicator, our interests are very much in line. So they're running this business, this apartment building, and they've got to pay employees and property management and all that stuff. But we split the profit. They get a certain percentage and we get a certain percentage. But they don't get paid until I, as the investor, has gotten all my principal back. So that means that they can't screw this up and they want to do it fast. And time is that if you look at things like internal rates of return, time is a factor. So the quicker that they can get the money back to the investor, the better that is for us. We can move it on to another deal. And if I put $100,000 into a deal, they don't get any of their split until all my $100,000 comes back to me, which is through the Burr method. Basically refinancing these deals as we've driven up the net operating income and the value's gone up.
I love it.
Now,
and
how would that be? What would that be if the stockbroker and your financial planner, they make money whether you make money or lose money? It doesn't make any difference. They have no risk in the game. They've got nothing in this game, but they're going to make money on you all the time through good times and bad.
Exactly, which is why I like your previous example where your interests are aligned with your partner's interest, because you either both make money or nobody makes money.
That's right.
I've heard of similar setups where somebody has a fund, like a private fund, and you invest with them, and you as the investor, you get the first, let's say 10% of the returns. Anything above 10%, you split with the person managing the fund. In other words, if that investor has a bad year and the fund only gets 5% that year, or then the person managing the fund gets nothing. Exactly. Like, they don't get paid until they can get you at least 10%, which I think is a really good way to set it up.
Yeah, I mean, it's just amazing to me that we're in this world where most of the population is just handing their money off, and the people that are making money off these 401k plans are not the investors.
Oh, totally. And what I find strange is, like, that's one of the few products where Americans accept that. For example, if I go to my local department store and I buy a coffee maker and I bring it home and it doesn't work, I want my money back. Like, I'm going to go back to the store and get my money back, right? If I'm at a restaurant and I get bad service, I'm not going to tip. But for some reason, like, this whole mutual fund 401k industry, it's one of the few places where Americans are just willing to pay the fee, whether they get good service or bad. Yeah, and I don't know why we as a society accept that. It's just, it's strange to me.
Well, I think it is changing. We've seen some really big swings in the economy over the last couple decades, and I think people are getting a little tired of this, and they're starting to look more and more. And with the technology we have today, there's just never been an easier time in history to learn something new, and there's just so much free information out there. What you're doing, what I'm doing, and so if you want to learn something new, now is the time. You have no excuses, really.
That's it, exactly. I love YouTube. I have a confession to make. I have a YouTube addiction, and
it's my favorite channel. I can tell you that.
And I am blown away by how much free information is out there.
Right.
Whereas maybe 10, 15 years ago, you would have had to go to one of these $10,000 or $15,000, seminars. Today, all that information is out there. If you have the patience, if you have the time, you get a notebook, you start taking down notes, and you go from this YouTube channel to this blog. Maybe you buy a book or two on Amazon. The information is out there. For example, you were talking about the ATM syndication earlier. Just today, I was watching this really cool video of this, and I'm going to put all these links in the show notes, of course, and I'll put this one in there too. It was a YouTube video made by someone in their 20s. They're in their mid-20s, and they were talking about how they essentially started making over $10,000 of cash flow a month from getting into the vending machine business.
Right, yeah.
And this person was saying, this is how I got started, and he was saying, I was having problems in high school, wasn't a good student, dropped out of college, and then I was able to buy this secondhand vending machine, and then I learned how they work, and then I got 2, and then I got 5. So he's running like 50 some odd vending machines, and he's and I'm like, that's amazing. It's amazing that information of how he did it,
Yeah.
how to do it. It's free. It's on YouTube. If you're interested, it's there. Like there's nobody has that excuse now. We're in 2022. Nobody's got the excuse to say, I have no idea how that works. I've never, I can't get any information on it. No one's telling me. It's like all the information's free. It's amazing.
Yeah, and it's interesting too. I mean, the people that I've come across and met, the very successful people, investors, everybody is so willing to share information and help everybody else out, and it's a really neat it's a really neat environment.
Chris, I want to go back a little bit to real estate. I'm a big fan of real estate. When you went through that period in your life where you had to, lose a lot of your net worth, and then had to sit there and say, okay, how am I going to get out of this? How am I going to reach my financial goals, etc.? And you decided to go down the real estate path. If somebody else wants to think about doing that, how much money do you think is required to start in real estate?
Well, I would look at some of the turn. I would look at some of the, somebody's starting out, especially if they're not an accredited investor, which means you have $1 million net worth and $200,000 a year income as a single person. I would look at the turnkey single family rental providers that are throughout the country. And, there are still houses that you can buy in the country for, $150,000. So you look at a 20% loan or less, for under $30,000, you could get into depending on the type of loan terms, you could get into your first single family rental, and you don't have to do it by yourself. You could do it with your parents or with a friend. Or my first property was a duplex when my daughter decided she wanted to not live in the dorm anymore at the beginning of her sophomore year. And I was still working my way out of this, this hole. And I knew this was going to happen, and I was actually still married when she went off to school. And I thought, when she decides she wants to live off campus, I'll be damned if I'm going to pay somebody else's mortgage up there for the next 3 years. So it was the time of President Obama's first time home buyer tax credit. So she and I bought a duplex, and she lived in one half and rented one of the rooms on her side, and we rented the other half. And I think we got a $12,000 check from the president, but I couldn't afford the down payment, so I called my dad and I said, how would you like to be a part owner in this building with me? And he did. And he got his part back on exit, and it all worked out really well. So it can be done. It can be done. I mean, especially there are people that are putting, $10,000, $20,000 a year into a 401k. Well, stop doing that, right? Take that money and save it up and go get yourself a real asset. Absolutely. Oh, and here's a fascinating bit of information. So, I just did this article recently too. So if you took $20,000, and we'll just pretend you could get $100,000 house, good rental anyway. But it doesn't even matter. But I think I did the math on putting $20,000 down on a $100,000 single family rental, and let's say you owned that for 30 years, and it never generated any positive cash flow, and it never went up in value. And then the question is, would that be a good investment or would that be a bad one? Well, because of the fact that somebody else paid off that $70,000 mortgage, that works out to be a 13.33% annual return with the property that didn't go up in value. And just the fact that somebody else basically gave you the $70,000 over 30 years, that's better than the S&P 500. And some of that is going to be non-taxable because of business expenses and because of depreciation.
Absolutely. That's amazing. I've never crunched. I like numbers. I like crunching numbers, but I've never ran that scenario that you just mentioned. But if that can generate, as you mentioned, I think you mentioned 13% return, right? Mm-hmm. Without generating positive cash flow. Yeah. That's quite incredible. Tell us a little bit more about, Chris, about how would you structure it? Would you recommend somebody buy the house in their own name, in an LLC, in a trust? And how can you get the best tax advantage situation?
Well, I do everything through companies, LLCs and various companies. Chris Odegard doesn't invest in anything. One of my companies does all that. And there's two reasons. One is from an asset protection standpoint and a liability standpoint. So if you buy a single family rental and you are you are renting to the public, and one of your tenants has an accident or injured or God forbid gets killed or whatever, you're going to be sued. And they're not only going to have access to that house that's in your name, but they're going to have access to everything else that is your name, owned in your name, your car, your house, your checking account, your brokerage account at Schwab, because they're suing. You're the person personally that rented them that house, so they're suing you, and everything that you own is now up for grabs. So when you buy that asset, either initially or afterwards, you transfer it into a company. Now, when they go to sue you, they're suing the company because that's who they did business. And what does the company own? Maybe it's that one single family house that has an 80% mortgage on it. So there's not a lot there to get, but you might lose that house. But let's say you had a portfolio of properties. So you don't put them all in one company. You decide, how much value or how many properties you want to put in each company so that a fire in this kind of silo in this company doesn't reach over into the other ones, and that they don't blow back onto your personal thing. And then the other thing too is, so basically if you're just doing this in your own name, you're a sole proprietor, and a sole proprietor doesn't get all the same tax benefits that a company gets. So the other reason is you want every available business expense that you can get, and to get that you need to have a business structure. But there are people that have been real estate investors all their life, and they've owned everything in their own name, and they say, that's crap, Chris, you just got to have insurance and an umbrella policy. And I'm like, okay, but I'm not doing it that way. I'm just not going to do it. It's a risk I'm not willing to take.
Another comment about the taxes, because one of the reasons why I like real estate is, yes, if you have a mortgage on it, of course, the interest is tax deductible. You mentioned, of course, a lot of the business expenses are tax deductible, and single family homes have I think a 29.5-year depreciation schedule, which also helps lower the taxes. So if somebody invests in a single family and they do it right, they really shouldn't have any taxes owing at the end of the year. And this is why I think a lot of people who have many houses or are real estate investors quite often have very small tax bills.
Yeah, right. No, it's just really, real estate is just the best investment. It really is.
I like it. So Chris, tell us a little bit more about your blog. What is the URL? Where can people find it?
Yeah, the blog is theprolificinvestor.net. And if you go right there, the front page, there's a link to the book. There's also a link if somebody wants to have a free 30-minute virtual coffee with me and talk about this stuff. I do that on Thursdays. They can get time on my schedule. But basically, I have a page for all the articles that I write, and a page for where the videos are. And I have a resources section, which lists the books that I like, the podcasts I like, different, where I do my apartment syndications and all kinds of stuff. So it's in every social media thing that I'm on, which is pretty much all of them. You can find those at the prolificinvestor.net.
Perfect. And Chris, you mentioned that you read Robert Kiyosaki's Rich Dad, Poor Dad. Are there any other personal finance books that you recommend that stand out?
Yeah, you need to read Tax-Free Wealth, the second edition by Tom Wheelwright. And that will, just like Rich Dad, Poor Dad kind of explodes everybody's mind about money and investing, Tax-Free Wealth will just completely reshift your mind around taxes. And what Tom Wheelwright says is that about 95% of the, I don't know how, let's just say the tax code is this thick. 95% of it is telling you how to pay less taxes. So it is a roadmap to pay less taxes. The government uses the tax code to incentivize public behavior for what it thinks is good for the society and good for the economy. And all you have to do is you say you want to play by the rules, and the government will be your partner in what you're doing, as long as you're doing the things that they think are good. They love real estate because people need a place to live. They like green energy and non-green energy because energy runs the economy. And so, and in 2018, I paid zero federal income taxes. I made a big deal about it because that's the same year. No, maybe it was 2019. That's the same year that Donald Trump only paid 750, and I called him an underachiever because why did he pay 750 in taxes? I paid zero, and I don't have it. I'm not Donald Trump. I don't have an army. I do have a CPA that does my taxes because you should not do this at home. And but I made some very specific investments. And I kind of overachieved and paid no taxes that year. So it's possible. It's really the low. It's funny. It's really the lowest hanging fruit. So if you said I'm an investor and I'm only getting 10% and I want to get 20%, you know what the easiest way to get 20% is to pay less taxes. You could say, yeah, I'm going to do a riskier investment to get another 10%. That's not the smart way to do it. Just pay less taxes.
Good point. Yeah, I agree. And I'm glad you brought up the example of Donald Trump. You know, a lot of individuals think that, you know, only wealthy people can do that because wealthy people somehow cheat and this and that. I said, no, there's no cheating involved. Like, just like I said, read the tax code, and most real estate investors who are real estate investors full time pay very little taxes. That's how exactly like I said, that's how the game is set up, because the government wants to incentivize people to invest in real estate to create quality homes and affordable homes for the American population.
Yeah. And you know, when I wrote that article, I picked a couple of quotes out of some newspapers around the world where there's, you know, the United States, there's two tax codes. There's one for the rich and one for the poor. And I just kind of dissected. I said, no, there's only one tax code, but there's, you know, if you want to say there's two, you know, there's one for the people who want to educate themselves, and there's one for the people that don't. And Tom Wheelwright says, hey, be a super taxpayer. What he's saying is not pay a lot of taxes. Just look at and you know, it's not like I have spent next to zero time in the actual tax code. When you start hanging around with reading the right books, joining the right groups, all serious investors are always looking at the tax landscape, what's coming, and we're always learning and keeping on top of what's coming down, and how are there going to be ways that the tax code is going to allow us to pay less, even though these things are going on. That's just part of being a sophisticated investor. And, you know, to me, it's just a big game, and it's a lot of fun, you know, playing the money game of making money and seeing how much money you can make and how little you can put in Uncle Sam's pocket because you've partnered with them. You know, it's really a lot of fun. And, you know, people can say, well, it's not fair or this or that. Well, it's kind of like, you know, the World Cup's going on. It's kind of like saying, well, I like soccer, but I don't like the rules, so I'm not going to play. Well, there's only one field to play on. You can either choose to play and use the rules to your advantage, or you can choose not to. I mean, and if you think it's unfair, we can all try to change things, right? And we should try to change things if they're not fair. But in the meantime, a little bit of self-preservation and, you know, doing things that help you financially. And, you know, life's just a lot easier when you don't have money problems. And if you have money, you can do whatever you want with your money. You can spend it on yourself. You can give it to charities, give it to your church. But you can't do any of that cool stuff if you don't have it to start with.
Exactly. And Chris, ending this on a bit of a personal note, what's left for Chris Odegard? What are some of your goals, personal, financial? What keeps you going?
That's a good question. I'm kind of trying to figure that out because I've kind of hit kind of a you know, a little bit of a wall. And the one thing I said that I don't like to trade my time for money. There is one thing that I would do that for, and in addition to writing my articles, I would like to get out on the speaking circuit and being in front of groups talking about that. And I just have to. January is where I'm going to sit down with a piece of paper and start kind of mapping out, you know, what I need to learn, what partners and people I need to help me figure that out. So and I'm kind of trying to manifest that because I recently updated my website, and there's a spot on there that says book Chris to speak at your next event. So, I started with that, right? And every time anybody asks me, I'm putting it out there. I have no idea how I'm going to do it, but it's one of the things I would love to do. It'd be fun. Yeah,
that does sound like fun. And I've heard it a lot from the FIRE community, right? The FIRE being financial independence, retire early community.
Right.
Because I live here in Silicon Valley, and so there are a lot of young people here who become very wealthy at a young age because they work for a company that goes public or something. And many of them say that once you quit your full-time job, it's a great feeling of freedom and exhilaration, and that lasts for a year or two. And then they said, and then it gets boring, and then you need something else to keep you going, to keep you focused, keep you motivated, keep you connected with people. And so it sounds like you are at that stage now where you're looking for the next challenge, right?
Yeah. Well, I had to remind myself that last year I wrote and published the book, and I moved from Seattle to South Carolina, and I had thought about doing the audio version this year, but I made a conscious decision. I said, you know what, next year, that being 2022, I wasn't going to take on any new big initiative. I was just going to kind of have just a more relaxing year, and in which I did, but I had kind of forgot that I consciously made that decision. And as we're here putting up against the end of the year, I'm getting a little restless to do something new.
Chris, thank you very much for your time. It was a great discussion. I really enjoyed it. And so again, the book is Get Off Your Ass and Manage Your Money. And I hope people read the book, and I hope that people get off their ass and manage their money. You know, it's funny. Somebody asked me the other day, like, why am I doing these podcasts? I just started. I'm kind of new on this journey. And I said, I would love to be, this is my goal. It's kind of silly, but I would love to be sitting in an airport like 5-10 years from now, and some random stranger comes up to me and says, are you the guy on that podcast? Yeah. It's because of you that I bought my first investment property or something. And then I'm going to say, thank you. That's why I'm doing this. So I definitely am in the same boat. I want to inspire people. Yeah.
And it's funny you should mention that, because I go to a lot of, I love taking road trips, and I try to make my road trips to an educational event where, I'm learning something about real estate or macroeconomics or whatever. And I have people come up and go, you're the prolific investor, aren't you? So I'm a celebrity in my own mind,
That's excellent. Chris, thanks again, and have a wonderful evening.
Thanks, Gabe. Appreciate it. Take care.